Speaking of cash flow and capital allocation, we continue to clean up our capital structure and favor debt reduction over other uses of capital at this time. This year, we have already redeemed our convertible notes and our 9.875% secured notes, which we completed this week, well ahead of its 2025 maturity. With this proactive approach, our most expensive bonds are now completely gone, and our annual cash interest expense is significantly reduced. Looking ahead, we have a few more tranches of debt that we can pay down with our cash flow, prioritizing our 6.75% secured notes as our next target. In a few quarters, our debt should be so low that it will no longer even be a discussion point, and I look forward to talking about other ways of returning capital to our shareholders at that time. Our LTM EBITDA of $6.2 billion already implies leverage of 0.8 times, the lowest level for Cliffs in over 12 years. As you can also see from this morning's release, we only spent $20 million in share repurchases during Q1, executed opportunistically at very attractive prices. Other than this, we used most of our remaining free cash flow generated during the quarter toward paying down debt, as discussed. Going forward, we will continue to favor debt reduction over share repurchases in the near term, and buybacks will continue to be only opportunistic. In closing, because of our domestically sourced raw material supply chain, as well as our heavy weighting towards fixed price contracts, our 2022 financial outlook is very compelling, with strong margins, record levels of free cash flow, and equity value creation through a massive conversion of total enterprise value to market value via debt reduction. With that, I'll turn the call over to Lorenzo. Thank you, Kevin, and thanks to everyone for joining us this morning. Let me start by summarizing the key highlights from our Q1 results, and then I'll provide some additional context around our increased outlook for the remainder of the year. Our adjusted EBITDA of $1.5 billion in Q1 of 2022 is 3 times higher than the year-over-year adjusted EBITDA in Q1 of 2021, boosting our last 12 months EBITDA to $6.2 billion, which is a record for any 12-month period in our company's history. Relative to last quarter, our sequential Q1 EBITDA was essentially steady with Q4, despite the sharp drop in spot steel prices that started around September of last year and lasted into early March of this year before rebounding higher. In late Q4 and early Q1, we also saw relatively weak service center demand due to generally elevated inventory levels. Despite this unfavorable backdrop of falling HRC prices and weak service center demand, we were still able to maintain a steady quarterly EBITDA level from Q4 to Q1, primarily due to the magnitude of our fixed contract price increases that went into effect at the beginning of this calendar year 2022, ultimately more than offsetting the spot price weakness backdrop and resulting in higher overall average selling prices for Cliffs quarter over quarter from Q4 to Q1. We have been foreshadowing that the strength in fixed price contract renewals would eventually materialize in our numbers, and that has now been clearly demonstrated through our Q1 results. From a volume standpoint, we also achieved a 200,000-ton sequential improvement in direct volumes to the automotive industry, our best shipment quarter to this end market since the semiconductor shortage began in the first quarter of last year. It resulted in improved sales volumes to 3.6 million tons in Q1. Going forward, as we expect the automotive sector to continue to improve and the distributors and converters market to replenish inventories, we anticipate sales volumes to increase further on a quarterly basis. During Q1, we also concluded negotiations on all of our remaining fixed price automotive renewals that reset on April 1st, with significant further price increases executed on all 1.5 million tons of annualized volumes that matured on that date. We are already benefiting from this price increase here in Q2. Beyond that, our next round of fixed price contract renewals will be negotiated this summer and repriced on October 1st, and we look forward to continuing this favorable pricing momentum on those negotiations as well. Now, adding additional context around our updated favorable outlook for the remainder of the year, we are increasing our expected average selling price by $220 per ton compared to our prior guidance in February. Our expectation is now for a full-year average selling price of $1,445 per ton at the current curve, compared to our previous guidance 2 months ago of $1,225 per ton, based on the curve at that time. This improved outlook is driven by 3 things. 1, our successful fixed contract renewals, as I've just explained. 2, a higher futures curve today compared to February. And 3, wider than historical spreads between hot-rolled and cold-rolled steel prices. On the cost side, we are better positioned than any of our competitors to mitigate pressures from the current inflationary environment, given our vertically integrated and internally sourced iron ore pellets, HBI, and scrap, as well as annual fixed price contracts for met coal.
Of 2014, a few months before we began the turnaround process at Cleveland-Cliffs. Our business at that time was to supply raw materials to North American steelmakers, and we identified the massive share of pig iron coming to the United States from Russia and Ukraine as unreliable and at risk. Representing two-thirds of all U.S. imports of pig iron at the time, it was pretty remarkable that no one was really concerned about it or working to reduce their dependence on both Ukraine and Russia. This helped us formulate our decision made in 2017 after we had already fixed the financial situation of the company to build a domestic source of virgin metallics with our Toledo direct reduction HBI plant. That was an attempt to provide the U.S. electric arc furnace market with a more reliable and carbon-friendly source of metallics, which they absolutely need to make higher specs of flat-rolled steel. In the 7 years following the invasion of Crimea, we were the only company to act on this potential to reshore or base metallic supply back to the United States. Fast forward, now that we are a steel-producing company, we are better off using our HBI in-house. That has allowed us to reduce our blast furnace footprint from 8 to 7 units, while maintaining similar level of the steel production output following our recent idle of the Indiana Harbor No. 4 blast furnace. This has also created a huge competitive advantage for us. With our own in-house pellets and relatively cheap natural gas, our cost to produce HBI has been just over $200 a ton. And that compares very favorably to the $1,000 per ton price tag for pig iron imported into the United States these days. The ongoing importance we placed on prime metallics did not stop with HBI. In November of last year, we acquired FPT, the leading prime scrap company in the United States. Since acquiring FPT just 5 months ago, we have already increased our access to another 400,000 tons of prime scrap per year, elevating our market share in merchant prime scrap from 15% at the time of the acquisition to 20% now. Both of these strategic moves, FPT and HBI, each underscored by our forward-looking view on the necessity of domestically sourced, high-quality iron units, have paid off in very short order. These actions were based on our view of the world, and we are benefiting now. Iron metallics are absolutely necessary to make high-quality flat-rolled steel. We at Cleveland-Cliffs are long on metallics in a country that is short of them. EAFs cannot make high-quality flat-rolled steel just by melting scrap. They need metallics. That's why they import so much pig iron, vast majority from Russia and Ukraine. Invasion of Ukraine by Russia on February 24 more than 4 million tons per year of imported pig iron supply have been disrupted. While the new situation hit very late in Q1, particularly due to vessels already sailing and material already unloaded on domestic grounds, 4 million tons out of a total of little more than 6 million tons is a full-blown disaster for companies depending on imported pig iron. For these folks, Q2 should be very challenging. Supply from Ukraine will likely be out of the market for a very long time due to the significant damage to blast furnaces, coke batteries, and other equipment that cannot be fixed quickly. As far as Russian pig iron, well, we are sure that production will not be discontinued. Due to outdated trade laws and powerful lobbying efforts, pig iron from Russia can still come into our country with effectively zero restrictions, even after Russia losing PNTR, Permanent Normal Trade Relations status, with the United States. The revocation of PNTR status came with half tariffs of 25% or above on most steel products from Russia. But the tariff on pig iron is still a meaningless $1 per net ton. This dates back to the 1930s, when pig iron was not even a product imported by the United States, and certainly not from Russia's predecessor, the Soviet Union. The impact on supply chains should have been a lot worse if we're talking about the invasion of Taiwan by China. But the ongoing invasion of Ukraine by Russia should be enough for a clear call for the end of globalization. We call it deglobalization. I believe deglobalization is the most important game changer of this decade in the United States and for the American people. Deglobalization is not just relevant for our industry, but for our customers as well. If the automotive OEMs had not set themselves up to be so reliant on imported semiconductors, they would have the demand to support the production of 18 million cars, both last year and this year, rather than the 14 to 15 million units they are currently able to produce. We are encouraged by investments made in onshoring this production, including a major $20 billion factory down the road in Columbus, Ohio. Cleveland-Cliffs is an automotive supplier, first and foremost, by far the largest supplier of steel to this sector. As also noted, Cleveland-Cliffs is an automotive supplier, first and foremost, by far the largest supplier of steel to this sector. As also noted, Q1 was our best shipment quarter to the automotive sector in a year. But we will be able to do much more in a fully utilized business environment. That day is coming, and the amazing results we have shown over the past year will only be further amplified once we get there. Looking ahead to the rest of the year, based on the rationale I have tried to lay out today, we are set to benefit from our perfectly constructed business model. There are 7 real producers of flat-rolled steel in the United States, and we are the only one among the 7 that does not rely on imported pig iron or slabs. In simple terms, the high cost that our competitors are facing from sourcing these materials will force them to keep steel prices elevated, and we will benefit through higher margins. Our cost structure is not nearly as impacted. Also very important, new flat-rolled mini mills ramping up capacity will only exacerbate their current issues with sourcing prime scrap and metallics, which will just further widen the competitive advantage we have. While I have focused my remarks on raw materials and substrate, the Russia-Ukraine conflict removed a lot of finished steel from the global marketplace as well, including slabs re-rolled in Europe. The war-induced steel shortage has pushed global steel prices up, making imports less appealing in the United States. We continue to read the same headlines about inflation, rising rates, driving slower growth, and the increasing likelihood of a recession. We long for the days that Fed officials will just keep quiet and do their job rather than giving doomsday interviews on Zoom almost every day. For us, underlying demand is good. Customer inventories have begun to decline, and issues related to sourcing labor or critical materials are showing signs of easing. The panic buying of 2021 is behind us, but we still have a lot of hungry mouths to feed, and that will only increase as the semiconductor shortages gets progressively better. Wrapping up, we did not wish for the current Russia-Ukraine situation and want to see peace soon. Russia should be punished for their vicious attacks, and the steel industry around the world, particularly the American steel industry, can play an important role in inflicting maximum pain to the perpetrators of this despicable act against the civilian population of Ukraine. We have geared our strategy around the importance of a domestic supply chain. And it's unfortunate that I have been in direct discussions with the CEOs of each one of these companies, these big clients of us. We are the biggest supplier of each one of them. You name it, we're the biggest supplier. And we are in direct discussions with them about how we're going to do next. Each one of them is also on the brink of developing new products in the EV arena, in the EV space, in the electric vehicles space. And this is very important to them. We are the sole suppliers of non-oriented electrical steels for the engines of these cars. We are developing the body and the exposed parts of these cars. We are improving the quality of these materials for these cars. So we are seeing their effort, we appreciate their effort, and we are working together with them to improve their own ability to forecast to us. When you deliver the amount of tons that we deliver every quarter, there's no other way to go. So we appreciate the interaction. We are seeing improvements, and the numbers, the shipment numbers are starting to show.
That's terrific.
Supply steel to the automotive industry. We are not a supplier of steel for the construction market. We are a supplier of steel for the automotive market. That's the biggest difference between us and our competition. It's not EAF against blast furnace. It's the market that you serve. We are designed to supply automotive. Automotive has been not so great, but it's getting better. That's us. That's Cleveland-Cliffs. So the future is bright for us. Competition is geared toward construction, and construction has been phenomenal. I'm not sure with inflation and stuff like that if construction will be good in the near and midterm future. So therefore, there's no incentive for me to do EAFs, to build an EAF, and try to nibble in construction. I don't have that confidence that the EAF type of market, that's basically construction, would be a good one for us. We have enough scrap to produce wide flange beams, to produce rebar. That's easy. Melting scrap to produce rebar, so walk in the park. The difficult thing in steelmaking is producing automotive steel, exposed parts. That's Cleveland-Cliffs, and the clients know.
Understood, and thanks for all the candor.
Emily, thanks for the question. First of all, the April contracts were a big success. We were able to achieve everything that we are planning for, and we are very thankful that our clients that were at the other side of the negotiating table understood our proposals and our good intentions. So we're all good, and we are in partnership going into not just to help them navigate their own problems with the supply chains, but also to help them go into electric vehicles. That's the biggest challenge that they have. As far as the negotiations that will come in the summer, toward the ones that we have to negotiate on October 1st, this is something that for us now is an ongoing thing. And we believe, based on what we have been in a daily basis discussing with these clients, it will be a no-brainer. It will be a no problem type of situation. In other words, the same level of high success that we got in the April 1st contracts, we believe we're going to get in the October 1st contract. With the addition that now the story and the proposition around prime scrap has been completely understood. Even more now than the competition is telling out loud that they don't need prime scrap. We do, and we do in order to provide the closed loop, to improve the environmental impact of our work together with them. They understand, and things will be fine. Yeah, let me start from the second one. Then I'll address the other markets beyond automotive. Look, we are already at 0.8 leverage. So we are at a very comfortable level. We will continue to pay down debt. So this number will continue to be reduced toward the end of the year. And at a certain point, we are going to seriously consider reinstituting a dividend. At this point, a dividend is not being instituted right now because we feel like we are getting more bang for the buck by paying down debt. As simple as that. Our goal of generating shareholder value is easily accomplished by continuing to pay down debt, as Celso explained so well during his prepared remarks. We'll continue to do that. And in a certain moment that I'm not going to commit right now, we are going to be reinstituting a dividend. We still have the buyback authorization in place, which will be used as an insurance policy. We are not trying to prioritize share buybacks over paying down debt. Pay down debt is the priority, and after that, after we get to a level that we are getting there. Well, we are not there yet. I want to pay more debt down before we institute a dividend. We will do what we were talking here in terms of a dividend. As far as the analysis on other markets, the OEMs outside of automotive, they are going through the same process as automotive. We treat them the same way. We want their scrap. We